Hi guys, this is the Smart Invest. In today's video, we'll once again be discussing a popular stock, namely Rivian. Many people predict a bright future for the so-called Tesla killer, but let's see what the fundamentals of the company reveal. Will it be a story of shining dreams or a harsh reality? Rivian is an emerging electric vehicle manufacturer that primarily focuses on producing electric trucks and SUVs. Since its founding, the company has garnered significant attention, often being referred to as a potential rival to Tesla. While Rivian shows promise in the realm of sustainable transportation, it's important to note that it currently lacks profitability and has accumulated substantial financial losses during its rapid development. To survive and achieve long-term success in their market, they still face many challenges. Before we dive in, let's make it clear that there will be no financial advice given in this video. Let's get started. As you can see, Rivian's market capitalization is $23 billion, and they had $3 billion in revenue TTM, resulting in a P/S ratio of 7.3. Now, let's take a look at the company's P/E ratio. Of course, Rivian doesn't have a P/E ratio, not even a forward P/E ratio. However, from the negative EPS of $6.47, we can see that not only is profitability far off, but they are currently burning around 27% of their total market capitalization annually. Now, what about the company's revenues? The company's revenues are growing, and they plan to manufacture 50,000 vehicles in 2023. Revenues are indeed increasing, which is a good sign, right? Well, I wish I could say so. The company's gross profit is currently negative. The gross margin stands at a negative 37%. This means that if they sell a car for $100,000, it costs them $137,000 to produce it. But what about marketing, research and development, and taxes? If we deduct these expenses, it becomes clear that, although Rivian's cash burn is showing signs of reduction, they still burned $1.2 billion in just the last 3 months. Their profit margin is 106%. Every car sold for $100,000 costs the company $206,000. With $3 billion in revenue, this doesn't look too good. You know what else is on the decline? Shareholders' equity. In the past year and a half, it has almost halved. At this rate, the company could remain financially viable for nearly another year and a half. Before we go forward, if you find this video helpful and educational, please hit the like button to support my work, and don't forget to subscribe and hit the bell icon so you can access even more valuable content in the future. Now, let's briefly look at free cash flow. While in Q1 2021, the company consumed $800 million in financing, in Q2 2023, it's already $1.6 billion. But don't panic. Some things are also on the rise. One example is the number of shares. As we can see, the number of shares has doubled in the past 2 years. But surely, the analysts will set things right here. Well, not really. Despite the fact that the company is currently losing $1.6 billion on $3 billion in revenue, analysts believe the company will increase its revenue to $25 billion by 2027, even in this optimistic scenario. But if this fairy tale-like growth were to happen, the company would already be generating a significant profit, right? Not quite. Even in this optimistic scenario, analysts believe Rivian would still produce a loss of $1.20 per share. Given all this information, everyone can decide whether it's worth the risk. What are your thoughts on the company? Will it eventually become profitable, or will it run out of capital and investor patience sooner? Let me know in the comment section. Thank you for watching the video, and if you found it helpful and want to support my work, please hit the like button. Subscribe and ring the bell to catch similar valuable content in the future. If you have any questions, feel free to ask in the comments section, and see you in the next episode.